Alright, today we're talking about the best way to get funding for your business. But at the end of this video, you'll know exactly the different types of loans, loan qualification requirements, required documents, and how to secure the best loan for your business. And it's a little crazy here at the office, but we believe that every time a business owner gets approved for a loan, like an angel gets its wings and is like singing and dancing. So please get a notebook and take notes so that you can put into practice the information I'm going to give you. Because I can promise you, this works. And by the way, I'm Sylvester, a funding specialist, and I can confidently assure you this because it's over 10 years of trials, tribulations, failures, wins, and losses with different types of loans and business industries. So if you're watching this, I know you can confidently get approved for that small business loan that you've been looking for to help you scale your business and finally enjoy doing what you love and not just banking. Let's start from the beginning when you're looking for a small business loan. So what would be the most valid reason as to why you'd be interested in getting a loan for your business? This could be for things such as expansion, cash flow, payroll, and even for emergencies. The list goes on. And please feel free to engage if you're about to take a small business loan and I'm not sure the reasons behind it will make sense, and I'll continue the discussion in the comment section. You see, most people realize this too late, but understanding things such as the type of loans, type of lenders, business age, cash flow, and how soon you need the funds will influence the method you choose to get funded. So with that said, let's start with the different types of loans. The first one is traditional loans. These are regular loans you can get from a bank or a credit union. They usually have fixed terms and repayments. You can apply for this at places such as Chase Bank, Bank of America, and even Wells Fargo, among others. The advantages with this include long terms, low rates, and large amounts. The disadvantages include hard to qualify for, needs collateral, and long processes and paperwork. It's good to know that this type of loan is best suited for businesses with a solid credit score and a good relationship with their bank. Okay, the next loan type is revenue-based financing. This is also known as alternative lending, and as the name suggests, it's the opposite of your typical traditional loans. So instead of all that crazy strict rules, they usually just want a few basics, things such as 1 year in business, a business bank account with cash flow, and a registered business. The advantages of this include its fast funding, with the money usually deposited into your account within 24 to 48 hours once approved. And it's easy approvals. You can get funding even with a low score. And last but not least, there's no need to put up collateral. The disadvantages include can be very expensive, especially with the fees. And it only offers short terms, mostly 18 months being the maximum. Now, I know what you're thinking. What are the different types of alternative lending? Well, to keep this video short, I'll give an example of one, but if you'd like a more detailed explanation, please leave a comment and like below, and I'll be sure to make up a follow-up video on this topic. So one of the most common types is the merchant cash advance. It's the best loan to bridge gaps between cash flows and for people with a low credit score struggling to either get approved for an SBA loan or a traditional loan. Alternative lending is one of the easiest types of loans you'll ever get approved for, and you won't believe how simple it is to apply for this type of loan. Just click on the link in the description so you can get help to apply for this type of loan or be matched with one that best suits your goals and business needs. The next loan is microloans. This is a loan best suited for new businesses with low revenue and limited credit history. The advantages of this include it helps build your credit and it's easy to qualify for. The disadvantages include it offers low limits, mostly $50,000 max, and it requires collateral and has high interest. The next loan is SBA loans. So this is a business loan that is backed by the government, or let's just say the U.S. Small Business Administration. So things nobody tells you is that being backed by the government means that they put guidelines, or we can call them requirements, such as 2 years in business, a credit score of 680, and other things we'll discuss in the video to make you qualify. But to add to this, they also guarantee a portion of the loan from the SBA approved lenders they work with. The benefits of this is that it allows the lender to offer you loans with better terms, better rates, and big amounts. But here's the thing, there's still a downside to their involvement because they also want to avoid risk. Therefore, the guidelines that they put in place kind of make the loan harder to qualify for, require extensive application processes, and require some form of collateral in order to get approved. It's good to know that this type of loan is best suited for established businesses with at least 2 years in operation, looking for a low rate and long terms. So I know nobody asked, but I'm going to tell you guys anyway. There's several types of SBA loans, but just for time's sake, we'll take a look at the 3 most common ones, which are the SBA 7A loan, SBA 504 loan, and the SBA Express loan. So the SBA Express loan offers up to $500,000 and are for businesses with quick cash needs. Once you apply, you get your decision in around 36 hours and have the funds deposited into your account within 4 weeks. The terms for this range between 7 to 25 years. The SBA 7A loan offers between $50,000 to $5 million and is considered the most flexible SBA loans. Terms can run from 10 to 25 years with approval and funding taking between 5 to 10 weeks. And last but not least, the SBA 504 loan. This offers between $125,000 to $5.5 million and is best for buying property and big equipment. Terms can range from 10 to 25 years and it takes 30 days to process your application and 90 days to get funded if you're approved. The next loan is lines of credit. This is a flexible loan that lets you borrow up to a set limit, use what you need, and only pay interest on what you use. The advantages include you pay interest on only what you borrow, and it's great for managing cash flows. The disadvantages, though, include they have too many fees. This is a video I explained that, but can also have variable interest rates and requires good credit and financials. The next loan is invoice factoring. This is when you exchange your unpaid invoices for instant cash. The advantages of this include quick access to working capital and no need for a strong credit. The disadvantages include high fees and you only get between 50 to 90% of your invoice value. This is best used to turn any unpaid invoices into cash. The next loan is equipment financing. This is the loan best used to buy business equipment with the equipment itself acting as the collateral. The advantages of this are easy approvals and you get to keep the equipment once payments are done. The disadvantages are you're stuck with payments just in case the equipment breaks down and it can only be used to acquire equipment. Here's the one thing I tell every new client looking for the best business loan: to always compare between secured and unsecured loans before making any type of financial decision. So what are the differences? Secured loans are backed by things such as property, equipment, or anything with value that the lender can take as part repayment in case your business defaults on the loan. This reduces the risk for the lender, which in turn kind of allows them to be flexible with things such as terms and rates for the loans. Examples of things that can be accepted as collateral include cash, cars, equipment, land, and houses. It's good to know that the collateral placed is based on things such as the type of lender, the amount you're borrowing, and your credit score. Unsecured loans, on the other hand, rely more on your business health and therefore don't require any type of collateral. But if you think about it, this kind of puts the lender at risk if your business struggles. Therefore, because of all that high risk, this loans comes with higher rates and shorter terms. So just cover the different types of loans. But let's be honest, you just can't walk into any bank with an ID and request for a small business loan. And if you do, I bet you people think it's luck, but it's not. It's through preparation by making sure you first qualify for the loan, then having the right documents such as bank statements, business certifications, tax returns, and a business plan. All right, now let's talk about how to secure the best business loan. To do that, you need to understand what lenders look for to approve your application. While it varies between lenders, here's a general idea of what they use. They use a common framework known as the 4 C's. The first one is capital. This means they look at your ability to pay the loan based on things such as your savings, earnings, and debt. The next one is credit. This is a look at your credit history and how responsible you are with payments and loans. The other one is collateral. This is the assets you can offer to secure the loan. And last but not least, conditions. This includes the purpose of the loan, time in business, and overall industry conditions that can make you eligible for the loan. All right, now, so if you've watched up to this point, then as I said in the beginning, that I believe you will get approved for that small business loan. So when that exciting time comes, you'll have different offers, and I'm about to teach you how to compare each and every single one of them like a pro, so you can choose one that best suits your business needs. The things you need to look for and compare include interest rates and APR, the loan processing fees, which includes but is not limited to things such as application fee, origination fee, and closing fee, the amount you net after fees and costs. Make sure that the amount shown is what will be funded into your account. The other one is terms, the amount of time they give you to repay the loan. And the last one is the type of lender. Do they offer secure or unsecured loans? So, if you struggle making choices, here's an example we can use to learn so that you can choose a loan that best suits your business needs. So, between loan A and B, would you choose A or B? Well, to be honest, there's no right or wrong answer. It's more about what best suits your business needs and situations. Let's give it an example with, let's say, loan B. See, loan B would look more favorable because of the low monthly payment. However, if you take a closer look at the overall interest paid, you notice that of loan A is lower by at least $500. The person taking loan B might not be able to make $152 in monthly payments and would be more comfortable with a less amount, say paying half of that to at least leave enough cash flow to run their business. So it's the same thing. Make sure you pick a loan that works for you and your budget. And if you'd like a guide on how to get the best business loans, you should watch this video right here.